All right. Good evening, everyone, or good afternoon, depending on where you are. And my name is Ray Kimbrell. Great to be with you all. Scott Durfee is on some well-deserved vacation time. And so it'll be myself on the chats. And joining me on the chats is the one and only Brett Crowther. So glad that he's with us. And so we'll try to keep up with your questions as we go through the day today. But today is Advanced Options Diagonal Spreads, and I'll be introducing Ben here in just a minute. I want to go over a couple of things just to get things ready to go. Today's the last day of our 4-day series on Advanced Options, and tomorrow, 10:30 in the morning Eastern Time, we'll be doing the question and answer period for 1 hour, just 1 hour, and it will not be recorded. All right, but this class today is, but the question and answer will not be recorded. And you all have done a nice job of putting questions into the event platform. And so keep doing that. I'll give you 1 hour from the end of class tonight to put those questions if you have anything for the diagonals. And then I will be putting all those questions together from all week long to get it ready for a hot and quick 1 hour session with Ben in the morning to hit those questions and hopefully clear some things up for you guys. So I appreciate you all doing that. And I also appreciate the surveys. Y'all been doing really well with doing the surveys for us. We'll put those links in tonight as well as we go through. And but the main thing we want you to do, folks, is listen to Ben. Don't get too hung up on the chats. And pay attention to the class so you can get as much out of the class as you can. You know, these classes are only an hour and a half. They're not meant to make you an expert in an hour and a half on diagonals or any of the other strategies. You gotta practice. All right. So listen closely. Ben's got a lot of great nuggets. I think you're going to really appreciate that. And he's going to give you a lot of great examples of world examples, as we say, throughout the whole night as we do examples here on the platform. Speaking of the platform, Ben, why don't we go ahead and get that next class, and we can next slide, I should say, so we can
absolutely
do the disclosures.
There we go, right there.
Yep, we are going to be live on a real platform, and Ben will be covering and looking at stocks throughout the night. Please understand that anytime Ben does pull up an example, we talk about this in the class. It's for educational purposes only. It's not a recommendation. It's not advice, and please do not look at it as such. Also know that you have a great opportunity to practice these strategies on Paper Money, and that Paper Money platform is just that. It is a simulated platform so you can practice and learn the strategies, but it is not the same as a live account, and things do change. So successful trading on Paper Money does not mean that successful trading will happen on your live account is in that same vein. Do understand that options do have risk, and they're unique to their own strategies. And then you can actually lose more principal than you put into the trade in some cases. So be aware of that. Understand the risk before you get into those trades. All right. With that, I think it's time to get this thing rolling. And we're going to have a lot of examples how to use our resources as we go through the night. Ben does a great job of doing that. And you can see Ben's been doing this for 1 or 2 years. Since 2005, he's host of Your First Trade, which I have been so honored to be able to help him out from time to time on that, on the Schwab Network. And that is brought to us, by the way, the Schwab Network by the separate but affiliated company Schwab Media Productions. And Ben specializes in teaching the Thinkorswim platform, technical analysis, stocks, options. And I can honestly say I think Ben can handle it all. I've been around the man for many years, and I'm very, very happy to say he's a good friend, and he's a great instructor. He's a great family man, and I think you're going to enjoy the night. So with that, my friend, take it away, Sir Ben.
Thank you, Ray. I appreciate that. And I'll tell you what, one other thing I wanted to do is really quickly just mention your background. I know you said that you are a regular contributor on the Schwab Network and regular contributor to the show that I am lucky enough to host and have the great opportunity to help produce and write, and that is Your First Trade. And the idea behind Your First Trade is to help everybody get beyond those obstacles and challenges to placing your first trade. And I think, Ray, you've done a great job in helping traders to do that, either, whether it's trading your first stock trade or your first options trade, or in fact, your first advanced options trade. Yeah. And you've been a big part of that. And you've been doing this since 2004 as well. So thank you for helping me out with this discussion today. I also want to point out, I know you mentioned really quickly, Ray, that we've got Brett Crowther out there in the chat as well. And I just wanted to say this. Brett is a 20 plus year veteran in the financial markets. He is a great trader in his own right. He's a great educator and a good friend. And so he is there to help out and answering your questions as well. And you guys are awesome at participating in that conversation along the way. And now I will say this too, if you are watching this in the recorded version, you can participate in the conversation as well. Leave your comments in that comment section, and we're going to get into this discussion here tonight. And again, I want to also acknowledge the help of our great producers who are helping to bring this out to you on YouTube and in our other respective channels, our reviewers and our supervision and compliance folks that do such phenomenal work in helping us to make sure that this is structured in a way that is helpful for you as attendees. So thanks to all of you. Here's what we've done so far. If you happen to be just joining us tonight, or you're popping into this out of sequence, what we've covered over this last week: long vertical spreads. Then we talked about iron condors, and we talked about that being the combination of short vertical spreads. Then we talked last night about calendar spreads, kind of a little bit different, because instead of splitting the strike price in calendar spreads, we were splitting the expiration date. That leads us directly to this idea tonight: splitting not only the strike price, but also the expiration date. And so as we start to do that, that gets us into this idea of a diagonal spread. And so I want to talk a little bit about this as we get into the structure and the construction and the use of diagonal spreads. I first want to answer one of the questions that often comes up about diagonal spreads, and that is, why would I, as a trader, want to use something like a diagonal spread, a trade that is a combination of a long option and a short option? We had that question on the first night when we were talking about long vertical spreads. Why wouldn't I just want to sell an option or sell a vertical spread, or use something that brings in a credit? And the answer to that question, the answer to the question of why a diagonal spread, is very simply, and we'll kind of get through that as we get into the goals of this section. The reason for a diagonal spread is we want to generally take advantage of directional price movement, and we want to do it in a way that gives us an opportunity to trade the benefits of a long option and perhaps offset some of the cost of a long option. And depending on how we structure the trade, may put us in a circumstance where we remove some of the directional risk in the trade. If you remember our calendar spreads last night, you remember the target for those calendar spreads kind of came to a very discrete and specific point. And if the price of the stock went too far one way or too far the other way, that trade became a losing trade. That calendar spread became a losing trade. Well, now we're going to shift that up a little bit. And so we're going to allow for an opportunity to take some of the directional risk off, meaning if the price of the stock moves up, or if the price of the stock moves down, depending on how we structure the trade, there is the potential to kind of lock in some of that potential gain in the trade. So as we get into this discussion, we're going to talk about the uses for a long diagonal spread, specifically long call diagonal spreads to take advantage of bullish movement, and long put diagonal spreads to take advantage of bearish movement. Now, you don't have to answer this question, but I'm just going to kind of ask this question rhetorically. How many of you, and just, you don't have to raise your hand, you can if you want to chat in, how many of you have long stock positions in your portfolio and already sell covered calls against those long stock positions? Many of you, I suppose, just given my experience and being out on the road and talking to traders and talking to people Many traders have long stock positions, and then they sell covered calls against those long stock positions. We know that when we sell an option, we create an obligation. Ray talked about that when he was talking through those disclosures. We know that that obligation, if we were to say, for instance, sell a call option, look at all those yeses. See, I knew it. I knew there were a lot of you. When we sell an option, we create an obligation. When we sell specifically a call option, we create an obligation to deliver shares of stock at the strike price. So we also know that owning the shares of stock to begin with is not the only way that we could satisfy that obligation that we create when we sell, say, for instance, call option. We could own the right to buy the shares and use that as an offset or as cover, if you will, for the obligation that we create. We talked about this with long vertical spreads. We talked about the fact that buying the option and selling the option created a risk-defined trade. Now, in a long vertical spread, we were doing that within the same expiration cycle. With the diagonal spread, we're going to do it within two different expiration cycles. So we're going to profit from sideways or modestly trending underlying stock with the sale of an option, the purchase of an option at the same time, with a further expiration and a different strike price. So splitting not only expiration, but also splitting strike prices as we get into this discussion. So I want to show you really quickly that risk profile. I'm going to just illustrate this, and then we're going to jump over to the Thinkorswim desktop software platform. We're going to take a look at this. So the long call diagonal risk profile looks very, very, very similar to the profile of a covered call, because we know that the ownership of the underlying stock, if we were to own the underlying stock, that has a risk all the way to zero. The risk profile of a long call diagonal is very, very similar. The max gain comes at the short strike. The max loss, as opposed to being the cost of the stock going all the way to zero, though, is simply the amount of the debit that we pay for the trade. Now, there's going to be a break-even point, but it's going to be difficult for us to calculate exactly what the max gain is unless we take into account the opportunity to roll the trade. So we'll get into that part of the discussion, into the management portion of this discussion as well. Now, if that looks familiar to you as the trader of a covered call, if you've thrown a covered call on the Analyze tab, you've seen something that looks a little bit like this, you might, on the other hand, not be quite as familiar with this type of risk graph unless you do something like a long put vertical spread. We talked about those the other day as well. So this is very, very similar, though, to a position that we might create if we were short stock and also short a put option. That would be a covered short stock position. And that would be a similar type of risk profile graph. Now, this would be a scenario where if the price of the stock goes down, our max theoretical gain comes at that short strike. Our max loss is the amount that we're paying for the trade. This would be a bearish long put diagonal. So let's do this. Let's pop out over to the Thinkorswim desktop software platform, and I'm going to just drop us in really quickly right into that Analyze tab, and we're going to take a look at an example of a long call diagonal spread. The chart here is United Airlines. Remember, anytime we look at individual symbols, these are for illustrative and educational purposes only. And there is that characteristic risk profile of a long call diagonal. So I'm going to grab my magic marker really quickly. We're going to mark this up. Then we're going to go look at the stock chart, and we're going to take a look at how we might construct this type of trade. So just a quick review. I know we've done it a couple of times, but I wanted to make sure that you have a clear understanding of how this tool works. I'm on the Analyze tab on the Thinkorswim desktop software platform, and I am on the Risk Profile sub-tab. That's navigationally where we are. So that's what we're seeing. Now, remember, this y-axis is profit and loss. And there's our zero line where that profit and loss change begins, right? So above that zero line, we're making a profit. Below that zero line, we're losing money in the trade. And then the x-axis down here at the bottom, that is the price of the underlying stock. So it goes up in this direction, it goes down in this direction, just so that we're clear. So what this risk profile graph tells me is if the price of United Airlines continues to go higher, I've got a range right here, and I'm just going to color this range in with my magic marker, and I'm not being exactly precise with it, but that's the range in which we make money on this particular trade. Now, if it goes really high, if it goes up here above this 140 mark, we might get to the point where this becomes a break-even trade, but it never really becomes a losing trade. In that case, it simply becomes a break-even trade, theoretically. But we do definitely have a point in this trade where there is theoretical maximum gain. And that theoretical maximum gain in this trade occurs right here at the short strike. Now, if we were to take a look at where those two strikes are, we are short the 97. And I'm just going to draw a line to where that short strike is. That short strike is where our maximum gain is. If the price of the stock is at expiration exactly at 97, then we may realize theoretical maximum gain. But I will tell you this, probably not. We're probably not going to get to that maximum theoretical gain in the trade, at least not right away. This is a trade that may require some patience. Now, the other side of that coin is we know that we are long an 85 strike option. So here's where that 85 strike is going to be. And if we were to draw a line right there, that's about where our 85 strike is. But our maximum loss in the trade is our net debit in the trade, what we are paying for this long call diagonal spread. So this has definitely a bullish bias. The expectation is that the price of the stock continues to go up. But remember I said that this is kind of modestly bullish? In this case, in the way that we've constructed this, it has a theoretical maximum gain. And beyond that, make more in the trade. Just like a covered call trade, we don't have an unlimited, we don't have that expectation of infinite maximum gain like we do with a long call or with the ownership of the stock. We have a finite limit. On the other hand, we're not risking the price of the stock all the way to zero because we're buying, instead of the underlying stock, we are buying a call option. So let's see how we might construct this trade. Now that we use this, now that we are familiar with this risk profile, let's go back and let's take a look at the stock chart and let's see how I put this trade together. And let's see how we might adjust this strategy in terms of making this work for us. So I'm going to go to the chart. We're going to take a look at United Airlines. And I've drawn a couple of lines here on this particular chart. I've been using this chart on the Schwab Network in the last few days. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. And I've talked a little bit about this, but what I've noticed in the last couple of days here on this particular chart is that it is still potentially moving in a bullish direction. And if I owned the underlying shares, this might be a circumstance where, as it runs into a resistance area, I might be considering selling a covered call. Now, that's not a recommendation. That's not suggesting that a trader should or should not sell covered calls against a long stock position in United Airlines. But that's the context around this long call diagonal spread trade. So if I own the shares of the underlying stock, one of the things that I know is that those shares of stock do not expire. There is a difference between owning shares of the stock and owning a long call option. The primary difference is that the long call option expires at a finite date. Owning the shares, I can own those shares forever, theoretically. Ownership of the shares also brings potentially dividends, and it also brings potentially ownership rights or shareholder rights. Owning the call option does not bring those things. Now remember, dividends aren't guaranteed, shareholder rights aren't guaranteed, those can and do change. but buying the shares of stock is going to be relatively expensive. It's going to cost me $89.73 at the moment per share to buy shares of the stock. And if we're going to use shares of the stock to create this type of strategy, they're going to be relatively expensive. So I need to pay attention to that fact. So using a long call diagonal, I can take advantage of directional movement. I can bring in some premium, and I'm not expecting just blow off the doors, blow off the top of this chart type of movement. I still want bullish movement. I still want directionality, but I'm not expecting enormous directional movement. So I've got a resistance level up here at about 94. I've got a resistance level up here from previous moves up around the $100 mark. So I'm targeting in terms of price movement somewhere right in this area, somewhere right around that $90 to $100 range. The price of the stock's currently sitting at 89. Now, we've talked about a couple of different ways in which we can source that potential move. Technical analysis is one way to do that. Probability analysis using the Thinkorswim platform and that implied volatility is another way to do that. So we're going to kind of use a combination of this. Technically, I can see that I've got a resistance up around 100. Now, if we were to take a look at also where implied volatility is currently, implied volatility, we've just come off of an earnings announcement about a week or so ago. Implied volatility is relatively low. Now, I'm going to say this. This is a trade that benefits generally from rising implied volatility because the primary driver of this trade generally is going to be the performance of that long option. And that long option is going to get more expensive, which is exactly what we want it to do. That's going to get more expensive if implied volatility rises. Also, it is expiring further away from the date than the short option. So it's going to have a greater vega sensitivity. Remember, we talked about vega and the nature of volatility and volatility sensitivity. Remember, we said that volatility sensitivity, if this is our earnings announcement, or excuse me, this is our expiration. So sorry, not earnings. That's a different E. This is expiration. This E is on fire. Remember, it's eating away at that value of the option as we get closer to that. Well, the vega sensitivity of an option gets smaller as we get closer to expiration, as opposed to some of the other option Greeks. So we're benefiting from if our long leg is, let's say, out here 150 days to go until expiration, and our short leg is here at 30 days to go until expiration, we have a greater, I'm just going to put in the letter V here, we have a greater vega sensitivity on our long leg than we have on our short leg. That benefits lower and rising implied volatility. Benefits lower and rising implied volatility. So there we go. Cool. I like that. I like that from the structure of this particular trade. So now that we have kind of a technical expectation, we have an expectation of what implied volatility is likely to do based on what we know about implied volatility. Now we can go ahead and we can structure our long call diagonal spread. So I'm going to go up here to the top of the chart. I'm going to go to the trade tab. So you know where we are navigationally. I'm on the Thinkorswim desktop software platform, specifically the paper money version of that. And I'm going to go to the trade tab up here at the top. And I'm looking at United Airlines. Now, on United Airlines, I've got a number of expirations here. I've got some weekly expirations. The other thing I'm going to pay attention to is I'm going to take a look at this current implied volatility percentile number down here. Notice where that current implied volatility percentile is? It's at the 8th percentile. That suggests that implied volatility is low. Remember what we said about implied volatility? I'm just going to reiterate this one more time because this is an important consideration in thinking about this. If implied volatility is low, it tends to rise. If implied volatility is high, it tends to fall. And we talked about that in relationship to that calendar spread last night. We talked about it in relationship to our long call or our long vertical spreads the other day. We talked about it in terms of our iron condors on the second day. So knowing what implied volatility is doing and what it is likely to do is an important consideration in putting together a diagonal spread. So we have a bullish bias on the stock. We have a bullish or a rising bias on implied volatility. And we know what time is going to do, right? Time is going to always slip forward into the future. So that knowledge, those three things, price, time, and volatility, allow us to structure this trade the way that we want to structure it. Now, I've done this kind of an extreme simply to be illustrative of what we could do in this particular trade. So what I'm going to do is I'm going to take a look at our long leg first. I've got a directional bias. Some of you might already be trading leaps options or longer term options in anticipation of price movement over a longer period of time. The one that I chose simply for illustrative purposes here was a 20 March expiration, which expires 239 days from now. That's a long time. That gives the stock an opportunity to move to the upside. And if I were to, again, buy the stock, I would be buying the stock at $89.73 per share times 100 shares. If I were going to buy an equivalent number of shares, that's going to be a fairly, well, let's just see what that would be. Right click and I go to buy and I click on confirm and send. That's going to be $8,975 that I'm going to have to tie up per 100 shares of stock. But now, if I were to, let's delete that, let's come back down here. If I were going to buy this call option, and I'm going to buy this call option a little bit in the money, I'm not going to pay $89.73 per share. I'm in fact going to pay about $16.50. Now, I'm a little bit longer out in time, and this is, we are after the market close. So these spreads have widened out a little bit. But I'm going to buy the 85 strike. That gives me a little bit of intrinsic value, gives me a little bit higher delta. And if I were to just stop at this point and buy that long call option, I have an expectation that the price of the stock is going to go higher. I look at the confirm and send button here, and it says infinite maximum gain. That's very seductive for options traders. They think, wow, it could go to infinity. Now, I will tell you this. I've watched Brett Crowther and Ray Kimbrell count to infinity twice. They did it as kind of a competition at dinner one night. But I know that the stock, even United Airlines, as far as it may and high as it may fly, is probably not likely, even in 120 or 296 days, not likely to go to infinity. So that's a lower probability. Now, it's not a zero probability, but it is a lower probability in this particular case. Now, that trade, to buy that long call, is going to cost me $1,650. That's about an eighth of the cost of buying the shares of the stock, but it still gives me that opportunity to run, lets the stock continue to move to the upside, and benefits from upward price movement, but it also suffers from time decay. And to be fair, that is still relatively expensive. That's $1,600 per share times 100 shares. So $16.50 per share times 100 shares, or $1,650 per contract. So I think we can do a little bit better in this particular case. There you go. I like that, Gary. 1 infinity, 2 infinity. I like that. That's very cool. Okay, so here's what we're going to do in combination with this. So I'm going to just pop this down, and I'm going to close down this expiration at 239 days. Now, by the way, you look at over here on the right-hand side, and you see where that implied volatility currently is. Remember, it's very low. It's in the 8th percentile. So this expected move is going to be relatively small as well. That implied volatility number, using that proprietary calculation based on implied volatility, based on the derivative pricing model, gets us to $26.76 of expected move in the underlying stock in the next 239 days. Now, that's not huge. That's nowhere near what we would see on, say, for instance, an index or maybe a more highly priced stock or a more volatile stock. But that's not insignificant. $26 move in 239 days. So what we're going to do is we're going to close that down and we're going to come back up here and I'm going to say, hey, I think I can offset some of the cost of that long call option that we're paying $16.50 for per share times 100 shares. I think I can offset some of that, much like we would sell a covered call against shares of an underlying stock to offset the cost of buying the underlying stock, right? Or to buy down the net cost of that stock, if you will, or bring in income, because you could consider this to also be perhaps an income generating strategy, depending on how you structure it. So in this case, I'm going to go out to the 15 August expiration. And one of the reasons why I chose that 15 August expiration, number one, is it's relatively close to expiration. Now, just real quick sidestep. Remember, we just talked about Vega and Vega sensitivity, but when we talk about theta sensitivity, I'm going to light that E on fire again. That is expiration. And remember, our theta decay curve mostly, generally, looks like this. I'm going to put a T in here to remind me that this is theta. So when I'm the buyer of an option I want to buy with a lot more time, I'm going to put in a B here for buy. And when I'm the seller of an option, I want to sell when that expiration is closer to the date. I want to sell when I'm closer to expiration. So by doing that, I increase the sensitivity of the short leg to the passage of time, and I decrease the sensitivity of the long leg to the passage of time. Time's going to work regardless. We know, as Annie tells us, the sun will come out tomorrow and time will pass. So we're going to buy an option that has a lot of time. We're going to sell an option that has a little bit of time. Now, Richard asks the question, well, how close is close? So could I theoretically sell a 1 day to go until expiration option? Yeah, I could. I'm probably not going to bring in much premium. So the counterpoint to this curve here is this balance that we looked at the other night. The amount of premium that we're bringing in versus the time remaining to expiration. More time to go till expiration, more premium. Less time to go till expiration, less premium. You got to find that balance point, right? You've got to find that balance point. So I'm going to start because I know generally that point on that time decay curve where this balance is kind of in balance is generally going to be right around that 20 to 30 day time frame. That's about the point where a typical option starts to fall off the edge of the curve. Doesn't mean that I can't sell my short leg closer or sell my short leg further away from expiration. I'm just trying to find the sweet spot in that balance. And the other thing that I can do is keep in mind one other thing. If I sell this when 22 days to go until expiration, I have this opportunity potentially, assuming that the price of the stock continues to move in the direction that it is going. I can roll to the next one, and then I could roll to the next one, and then I could roll to the next one, and 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 then finally roll into that long leg and potentially close the trade down. So that gives me theoretically, if we were to do it with that type of frequency, 1, 2, 3, 4, 5, 6, and 7 potential roll opportunities to keep that trade going, and 1, 2, 3, 4, 5, 6, 7 opportunities to eat away at that cost of that long call option. So this is why we are thinking about structuring this particular trade. Now, Chris in the Crumbs asks this: doesn't that roll cost you money? I'm going to remind you of the phrase that I used last night. If you were here with us last night, roll it for a credit or just forget it. If it starts going against you, meaning if the directional trade starts to go against you, close it down. Close the trade down or move the trade. Close it or move it. There you go. So roll it for a credit or just forget it becomes kind of the mantra that we want to think about here in terms of putting this trade together and managing this trade. And in terms of closing the trade down, again, we don't want to remain static. We're not stuck with that original structure of the trade. We can always change that trade down, change that trade or close the trade down. As my good friend Kevin Hinks, who helps me, who you may see frequently on the Schwab Network, and also helps me to teach this in the live version. As he says, we don't want to be in the storage business. We want to be in the moving business. So we always want to be thinking about moving our short leg or moving our long leg or closing the trade down instead of just keeping that trade static all the way through expiration. So we want to be in the moving business, not the storage business. Roll it for a credit or just forget it. So let's see how we might structure this trade. So we've already put in the long leg, and I'm holding down my control key here. I put in the order to buy the 85 call in that March 20 expiration. Now I'm going to go to that 15 August, 22 days to go until expiration time frame. Oh, and one more thing before we choose which strike price. Let's come over here to the right-hand side and let's see what our expected move is. It's about $7.39. $7.39. So price of the stock's currently at about $89, $90 roughly. So a $7 move up or down is going to put this at about 97 if our directional assessment is correct, that we may see the price of the stock move to about 97. If we go back to the chart, where did we say that we thought the price of the stock was likely to go? Somewhere here between this resistance at 92 and this resistance up here at 100. I think I even mentioned 97 kind of along the way here as a possible move. So let's go back to the trade tab. And let's come back out here and let's choose a strike price. We know that we're in this case already long or putting together the trade with a long 85 call. And we're going to sell against that long 85 call. We're going to sell a 97 call. And when we do that, now these spreads have widened out a little bit, but I'm going to sell that 97 call that expires in 22 days, sell it for $1.06. And that means that our net debit in this particular case, is $15.03. We've bought down or brought down the cost of that long call option, was $16 and some odd cents. We've now brought it down to $15.03. And if we go to confirm and send, things change a little bit. Now, I don't have a theoretical maximum profit. The reason is when it calculates this, when we put together this trade on the Thinkorswim platform, it assumes that I'm likely to roll that trade. So it's not calculating a maximum theoretical gain in the first iteration of this trade. Gives me the opportunity to think about rolling the strategy. But it does give me a maximum theoretical loss, if you want to think about it from that standpoint, in terms of the cost of the trade. Now that cost of the trade is a little bit less, not significantly so, but it is a little bit less. Now, if we wanted to reduce the cost of the trade even more, we could sell a more expensive option, but that has a lower probability of success, less headroom for the stock to move, and we'll see how we might manage that here in just a moment. So here's our trade, long the 85 that expires on the 20th of March, short the 97 call that expires on the 15th of August. And if we know what our rights and obligations are, we can decode this trade. We know that we have a right to buy the stock at 85 all the way out to the 20th of March. We know that we have the obligation to deliver the shares of the stock at 97 all the way through the 15th of August. That's when that obligation exists. If we don't like it, move it, change it, right? If it doesn't still fit our characteristics, move it or change it or close it. So I'm going to right click and we're going to go analyze trade. We're going to send this to the analyze tab. There is our trade right there, buying the 85, selling the 97, and you can see what that risk profile graph looks like. Now, if I wanted to adjust it at this particular point, the great thing is here on the Thinkorswim platform in the Analyze tab, I can adjust this trade. So what I'm going to do is I'm going to move my strike, my price slice right here to the current trading price of the stock. The stock currently is trading. Let's go back to that chart really quick. I want to double check on the chart, 89.73, right? 89.73. So let's go back to the Analyze tab and let's move that price slice to 89.73. That's right about there, 89. We'll kind of squeeze that in there. 89.73 is right about there. That's the current trading price of the stock. 89.78, 89.73. So we can see what that trade looks like from a net Greek perspective. We're long delta, meaning it's directionally sensitive. We are long theta, meaning the front month, the front expiration, the one that expires on the 15th of August, is eating away, decaying away faster than the long leg. That's exactly why we chose that separation of those expiration dates. And it is volatility or vega positive, meaning if implied volatility goes up, that benefits this trade. How cool is that? So we know we've selected a trade that is bullishly biased, technical analysis or whatever expectation that we have, and we've created a trade that is directionally sensitive. It's not hugely directionally sensitive. It's less directionally sensitive than just the long call option by itself, but it is still directionally biased. It's still bullishly biased. It still has a positive delta to the tune of 42 deltas. It is time positive. So the passage of time, instead of hurting us, instead of us facing the ravages of time, which so many people, fight against, we're putting the ravages of time to work in our favor because it's eating away at the value of that short leg fast, eating away at the value of the long leg slow. That helps us. And it is volatility positive, which means if implied volatility goes up, it helps our long leg faster and to a greater degree than it hurts our short leg. Cool. Volatility positive, time positive, direction positive. I like the way that trade is structured from that standpoint. We've put those three factors to work in our favor. And if the price of the stock goes up, cool. We have the potential to make some money in this trade. If the price of the stock goes up a lot, well, guess what? We've got a finite capacity to have that price of the stock go up above our short strike, above that 97. So we can say, look, here's our short strike. And at expiration of that short strike, that's where we're going to realize theoretical maximum gain in the trade. But you notice what now starts to happen. Our directional sensitivity begins to go down. In fact, as we move our price slice up, let's say if the price of the stock goes to that 100 level, which was that next level of resistance. Notice what's diminishing? Our deltas, our long deltas. So the more this goes up, the less directionally sensitive it becomes, the less theta positive it becomes, and a little bit more vega sensitive or vega positive, but not enough to offset that directional upward movement. So if this makes a big move to the upside, let's say it goes up to 110, our delta begins to eat away simply because these options are now both going in the money, and the intrinsic value component is diminishing. We're losing that benefit of having some extrinsic value because as these options become in the money, if they go way, way up, now there's very, very little extrinsic value remaining here. So the benefit of the passage of time actually kind of reverses on us. Implied volatility going up might help us, but if the price of the stock's going up that far, guess what's likely to happen to implied volatility? It's likely to come back down a little bit here as well. So directional, but not hugely directional. Passage of time works for us, but only up to a point. And implied volatility works for us, but as it gets deeper in the money, maybe not enough to offset the potential. So if it goes to the other side, if it were to go down to 80, becomes more directionally sensitive, becomes less theta sensitive, and more vega sensitive. In fact, that theta sensitivity reverses a little bit because now both of those options are out of the money. Both of those have a higher, in that component, in this case, theta sensitivity, and we lose a little bit of that advantage. So this is a trade that we want to have work and work for us and work for us fairly quickly. And if we want to change this, if we wanted to change the structure of this trade, I'm going to put that on our current trading price of the stock right now. Once again, I put our price slice at that 89.73. I'm going to put it right there. And if I were to change the nature of this trade, if I were to bring that range back down a little bit, I'm going to change my 97 strike to, say, for instance, a little bit lower strike. Let's make it a 95 strike. So we make this a 10 wide diagonal spread. You now see that because we're getting paid a little bit more, the cost of the trade is a little bit less. We lose a little bit more of that bullish sensitivity, and it starts to go down. If I were to push this out a little bit, make that short leg instead of 97, if we were to make that 100, I'm going to bring in a little bit less premium. Notice what happens to the trade. The trade costs me a little bit more, but it gives me this scenario where the price of the stock could go higher, and I have a longer range in which I could make money in the trade. In fact, I lock in some directional sensitivity to the upside. In fact, because if we were to continue to go higher and higher and higher, I reach a finite limit. So if I wanted to expect a big move to the upside, I could extend that short leg out a little bit in terms of out of the money. The trade's going to cost more, but it kind of locks in that upside potential of the trade. Now, that's not the only side that I can adjust. I can put that back to the 97, and we'll kind of bring this back down a little bit, and we'll see how we might adjust this. I can take this trade now to the side of let's pay a little bit more for that long option. So we bought the 85. If we were to maybe go a little bit deeper in the money, let's say we go to the 82, we're going to pay, whoop, that 82 is not traded in that expiration month. Let's go to the 80. Now that trade's going to be a lot more expensive, and you can kind of see what has happened to this trade here in terms of where that price of the stock currently is. It's at the 89.73 range, right about there. A little bit less delta sensitivity. Theta sensitivity goes down. We lose some of the benefit, and we gain a little bit of vega sensitivity, but the trade costs us quite a bit more. So we're always trying to find kind of this sweet spot in this particular trade, and how we structure this trade. But we also give ourselves that kind of greater range. It shifts or tilts this expectation, but it increases our maximum theoretical loss in the trade. Now, we've done a number of things on this particular risk profile graph. I wanted to take just kind of a brief half step here for a second, and I wanted to point this out. If you wanted to learn more about how to use the thinkorswim desktop software platform, this is a great opportunity for you to just take a moment, click on that QR code if you have not done so already. I know many of you did the other night, many of you did last night, but if you have not done so already, go ahead and click on that QR code or type in that URL down at the bottom. Sign up for a 45-minute thinkorswim desktop software platform walkthrough so that you can learn a little bit more about how to use the platform. Many of you are brand new to this platform, which is awesome. Many of you have been using the platform for a long time. This is a great way to increase your knowledge about the platform. increase that understanding about how this platform can work for you and to your benefit. So take just a moment to do that. Also, while you're doing that, if you haven't done that already, that's okay. Go ahead and take advantage of that. But I wanted to show you where you can find some of those additional resources right here at schwab.com/coaching. And Brett Crowther and Ray are both putting out these links in the chat. You can go right here to schwab.com/coaching. You've got the calendar for our live and upcoming webcasts. You've got our calendar for our in-person events that are coming up. And then you can go over here to our Trader Talks webcast page. And when you do that, remember to click on subscribe. And when you're here, clicking on subscribe helps you because it makes it easier to find this archived content. It makes it easier to search for it. Makes it easier for other people to find this content when you click on subscribe, and allows you to set alerts for when we drop new content as well as archives. And you can search for something like diagonal, and you just type that in, and now you see all of those webcasts. In fact, Cameron May taught one today, diagonal spread strategy, using charts to identify an income window in a diagonal spread strategy. So some great opportunities to be able to use this. Here's the webcast that we're talking about right now. Here's the session that we are in currently. You see lots and lots of resources to be able to learn more about diagonal spread. So we would love to have you do that and learn more about this platform. And again, one more time, there is that QR code so that you can sign up for these walkthroughs. So good opportunity to do that and learn a little bit more about these platforms. So I wanted to just do this really quick. I know a number of you have been asking in the discussion about what kind of stocks you might choose to put on for a diagonal spread. So here are some considerations to think about before we jump back in here. Consider securities with high daily volumes, liquid stocks, right? Liquid underlying stocks. You can do whatever fundamental analysis you want to do to choose that particular stock. Generally, we want to consider stocks that have lower implied volatility, that has the potential to rise. And directionally, if you're looking at call diagonals, a stock that has a directional bias bullishly. If you're looking at put diagonals, a stock that has a directional bias in a bearish direction. And then you also want to consider the liquidity of the options on the stock. Make sure that those bid-ask spreads are relatively narrow. Make sure that you are a small fish in a big pond when it comes to volume and open interest. All of the considerations that we've been talking about throughout this week still apply here when we're talking about the stocks that we choose for a diagonal spread, a long call diagonal spread or a long put diagonal spread, either way. So let's pop back over here to the Thinkorswim platform and let's kind of take a look at where this trade is. I put this trade on earlier today. And it is a function of a trade that I had been walking through for some time in my examples. But I'm going to go to my monitor tab. And once again, I'm on the Thinkorswim desktop software platform. I'm going to go to the monitor tab, and I'm in this group right here that we've created for this class, Advanced Options Virtual Workshop. It's my group within my accounts. It's not a shared group or anything else. It is simply where I keep track of those particular trades. And you can organize your platform this way too. That's a question you can ask when you do that 45-minute walkthrough of the Thinkorswim platform. How do I create those groups that Ben has or that these other traders have? So I will tell you this, one of the things that I did earlier today in getting ready for this particular class is originally I had a very deep in the money call option. In fact, I had a 35 strike call option here on United Airlines that was expiring on the 16th of January of next year, 176 days to go. It had appreciated to the point where it was trading currently at $56 a share. I think I paid probably in that particular case somewhere around maybe 15 or $20 per share for that contract. It had appreciated significantly. In fact, it had gone up. I had had that long call in there for some time. So what I did is in anticipation of this particular discussion, I rolled that long call option, which means I sold the January 16th expiration 35 strike call, and I bought the March 20 expiration 85 strike call. So I rolled that strike way up to the 85 strike, and I ended up paying for that strike $17.25. And then to create this diagonal spread, I sold the 15 August expiration 97 call, just that same process that we went through. And I sold that for $1.39 originally. So that brought down the cost of my long option, the 85 call option. And you can see what's gone on with this long option from the time that I put this trade on, or excuse me, the short option. From the time that I put that trade on, I brought in $1.39. It's now currently trading at $1.09. So it lost about 30 cents. Part of that was implied volatility went down a little bit. Part of that was the fact that the passage of time happened. Part of that was the price of the stock went kind of down just a little bit, down to the tune of about 70 cents. So you know what? That's okay. That ate away at the value of that short option, which is exactly what I want to have happen. Now, if I wanted to, I want to show you how we would go about managing or rolling this particular trade. Then we're going to move on to another example. So I'm going to come up here to the symbol, and I'm going to right click, and I'm going to say, if I wanted to close down this diagonal as a whole, I could sell this whole diagonal right now by creating and choosing from the position dissector here, this order to sell the whole diagonal as a whole. Now, I would be in a slightly losing position based on what I paid for the trade and what I brought in. I would be in a slightly losing position here at this particular point, and that's okay. But I'm probably not going to choose to do that. But if I felt that maybe something had happened fundamentally to United Airlines or directionally to United Airlines, I might consider just closing the trade down. Now, I could also create a rolling order. And remember, we talked about the fact that I have that opportunity to roll 7 times, I think, in this particular trade. So if I wanted to roll my 15 August expiration into the 22 August expiration, I could simply come down here to the position dissector, and I could sell a rolling trade. And if I were to do that right now, I would be buying back the 15 August that I am short, and I would be selling the 22 August and creating a new short position, rolling it for a credit. Remember, roll it for a credit, or just forget it. So in this particular case, if I were to initiate a rolling order, I could do that. Now, here's the other thing to think about as we've kind of come full circle in the management of this particular trade. I want to delete that rolling order that I was hypothetically looking at. I want to go back to the Analyze tab here for just a second. And I'm still on, let's move this back to our original example. I'm long the 85, I'm short the 97. And my maximum gain theoretically occurs up here around that $97 mark. Okay. If the price of the stock were to go to 97 at expiration of the short leg, we were right there. I could theoretically realize that maximum gain. It may not be as much. It may not be as much as the maximum gain that I could get out of the trade by selling those short legs again and again and again by rolling that strategy. But I could look at this trade as a one and done type of trade. So if we know that the maximum width of this spread is $17, right? Because we are long the 85 and we're short the 97. That's a $17 disparity between those two, $17 difference or width of that spread. Theoretically, the most that this spread could trade at is that $17. So if I were to trade this as a one and done, that's really, if you think about it, that's the most that I could get out of the trade. But I could potentially put an order on to take this trade off if it were to make, say, so right now our debit is $15, $2 would be the maximum theoretical gain on top of that. I could look at taking that trade off if, for instance, let's do this, right click, and we're going to copy this trade, and I'll put this back down here in my order box. If I wanted to take this trade off, if this were to make $1, meaning if implied volatility were to bump up, or if the price of the stock directionally were to move, or the bid-ask spreads widen out and it happens to price close to that price, if I were to change that single order to first trigger sequential and then right-click and create an opposite order to close the spread down, I could create an order, a limit order. Remember, limit always says or better. If I could sell this diagonal spread back for, let's call it $16. Don't call it $16.03 or better. And we'll make that order good till canceled. And now what I've done is I've put on the take profit order, not at my maximum theoretical gain, and certainly not at the maximum potential gain that I could get if I were to roll the trade. But if I were going to do this as a one and done type of diagonal spread, now I could put that order in to take that trade off, if it prices at about 50% of my maximum theoretical gain in the trade. I'm okay with that if I'm willing to trade this as a one and done. If I'm looking at trading this over a longer period of time, like, say, for instance, a covered call, where I'm looking at rolling that covered call again and again and again, well, then I might not put that particular order on, because it could very well take that trade out. And then that's not a problem, but I'd have to build another trade to take advantage of that, right? So you're right, Rich. It is an expensive trade for $1 potential profit. And that's why oftentimes many traders will not do a diagonal spread as a one and done type of diagonal. So that's, one of those circumstances where you might have that choice in terms of taking the trade off, how you choose to trade the strategy. But here's the thing to think about. And you remember, this is a long vertical spread, essentially, but it is a long vertical spread with a diagonal or with a calendar component to it, meaning we've spread our strike prices. Now, you know what we could do in this particular scenario? I'm going to drop this back down out of the way, and I want to compare this to, say, for instance, a long vertical spread, one of the things we were already familiar with. So I'm going to come back up here to where it says add simulated trades, and we're going to go to that shorter dated expiration. That's the 15 August expiration. And I'm going to create a shorter dated vertical spread, long vertical spread. So I'm going to go to the 85 strike, and I'm going to right click, and I'm going to say, let's buy a vertical spread. Now I've got that here in this trade, right? I've got that here in this location down here. I'm going to take that credit. I'm going to take this one out of the equation. We'll delete that one. Now I've got those two. What I want to do is I want to just simply create a vertical spread. So right click, buy vertical. Here's my vertical. I've got a couple of them. In this case, I want to take one of those off because I did this a couple of different times. And whoops. Oh, I know what it is. I want to show all. There we go. No, I don't. I want to take those off. There we go. That. And we will just bring up down here in the bottom. Let's take that one off. Delete that. We'll bring up our order down here at the bottom. There's our vertical spread. What I want to do is I want to adjust this vertical spread so that I am selling the 97 and I am buying the 85 in the same month. And I'm going to do this. I'm going to send this to the Analyze tab so that I've got both of those in place. Okay, now we're going to hide our positions. We're just going to show those two. We're going to go to the risk profile graph. So This is our vertical spread, right? If we were just doing this all in the same expiration month, that is our vertical spread. Now, what if the price of the stock goes up? We could be in a position where we are assigned early on that short leg. But that might put us in a theoretical maximum gain. But by extending the duration, we've extended the amount of potential gain we could take in the trade. So it looks very similar to a vertical spread, but it is different. It gives us duration to that vertical spread. So I wanted to just kind of compare and contrast that discussion here. Now, what I want to do is I want to look at that possibility of taking the other side of the direction in place here. So what I want to do is I want to come back over here to our monitor tab. And what I've done is I've created a long put spread, a long diagonal put spread. So I'm going to go to the chart and we're going to change the chart to TSLA, Tesla. So Tesla has just had an earnings announcement, and directionally, it's made a move to the downside. And we can see that move right here. We can also see what's gone on with implied volatility. Implied volatility has dropped. So implied volatility relatively low at this particular point. So one thing to think about is as we put this trade together for Tesla, again, we're going to trade that disparity in time decay sensitivity and volatility sensitivity. Implied volatility is relatively low. In fact, if we come down here to the current implied volatility percentile, it's at the 7th percentile. It's even a little bit lower than United Airlines was. But directionally, we have a bearish bias because the chart suggests that this has been moving in a bit of a, even if we were to come back here and we were to draw across the top, we're in a little bit of a descending triangle, potentially with some support right here. And we have an expectation that this might go to the downside. Now, a couple of different ways we could play this. We could buy a long put option. That's going to be expensive. It's going to suffer from time decay greatly. And we've got to be directionally correct quickly in order to overcome time decay. We can short the stock, but that's going to require borrowing and margin cost and complexity. Or we could create a long put diagonal spread to kind of give us the maybe the balance between those different scenarios. So I've got a level of support perhaps down here, technically maybe around that 271, 272 level or so, right about there. So that might be where I would look for a move technically. I've also got a level of support down here at around 210 or 211. But let's go back to the trade tab and let's put this trade together. I'm going to say, all right, fine. I'm going to go out to about 57 or 60 days to go until expiration, the 19 September expiration. And I'm going to buy kind of an at the money or maybe even in the money put option here. In this case, the 320 strike gives the stock the opportunity to continue to move to the downside. Now, that's going to be relatively expensive. It's going to be more expensive than our trade on United Airlines because this is a $300 stock as opposed to an $89 stock. But if I buy that put option, right click, or excuse me, let's delete that. If I buy this put option by left clicking on the ask price, $29.85 per share times 100 shares, $2,985. I don't have infinite maximum gain, but I do have the gain if the price of the stock goes all the way to zero, $29,000. The likelihood of Tesla going to zero is probably a little bit larger than United Airlines going to infinity, but it is not, not significant. It is not a big possibility. Depending on what you think about the stock, maybe your opinion might differ a little bit. But that's going to be my base suggestion here. My base idea is that the price of the stock is likely to go lower. Technical analysis suggests that. So that's our first leg of our trade, buying the 320 put strike. Then I'm going to go a little bit shorter in time. I'm going to go to the 1 August, 8 days to go until expiration. And the reason for that is there's still a little bit of inflated implied volatility in that option. And my expected move is about 20 points. Well, the stock's currently sitting at about 305. And so if I think that the stock might move 20 points to the downside, right? 305 minus 20 is 285. We go back to the chart and we just cross-check that. So that's a little bit, well, that's just about a level of support there too, where we've seen the price and stock move before. Not quite as aggressive as 275. 285 is not as aggressive. It's certainly not as aggressive as moving all the way to that support level. So I'm okay with that. Let's go to the trade tab once again. We're going to open up the 1 August expiration, and that is 8 days to go, where we might see the stock make a 20-point move to the downside. So we're going to scroll back down here and we're going to say, fine, let's go about the 285 or 290 strike price. I chose in this particular case, when I put this trade on, the 290 strike price, because the price of the stock was a little bit higher when I put this trade on. And I'm going to bring in $2.93 in putting this trade on. And now I've got a long put diagonal spread with a cost of $26.81, less than the cost of a long put by itself. And if we were to look at this in terms of our option chain, here's how many times I have potentially to roll this trade: once, twice, 3 times, 4 times, 5 times, possibly even 6 times, rolling it into that last expiration, that 19 September expiration. So 6 times potentially, 5 realistically to roll this trade, 5 opportunities to bring in more premium and chip away at the cost of that long put option again and again and again and again. And that's the idea behind that particular structure. So if we were to pop this trade back up here, there it is. There's our trade. We click on confirm and send. No theoretical maximum gain because we don't know what our roll potential is. Our cost of the trade, $2,681. Ostensibly, that is going to be our max theoretical loss in the trade, what we pay for it, because it is a debit trade. Now, if I right click and I send this to the Analyze tab, there is that familiar diagonal spread risk profile shape, just from what we were looking at in the call spread, flipped the other direction. So my expectation here is that the price of the stock goes down. I want the price of the stock to go down in this case. This is a directionally sensitive trade. And that's okay. We can use a put diagonal to trade a bearish bias. We can use a call diagonal to trade a bullish bias. And that's why we look at both sides of this equation. So what I'm going to do now is I'm going to look at my short strike. My short strike is the 290 strike. I'm going to put my price slice there. Directionally sensitive to the downside. Not as directionally sensitive as our United Airlines was, because the delta on this long leg is a little bit lower. And the delta on my short leg, in this case, a little bit higher. So I have a smaller net delta here. Net delta, 17 deltas to the downside, still directionally sensitive, but I've got that kind of locked in directional sensitivity here to the downside in this particular case. Look at the theta on this. Every day that goes by, this is working in our favor. And look at the direction or the volatility sensitivity. If implied volatility goes up, the implied volatility goes up, that is circumstance that benefits us. Now, if the price of the stock goes down, what typically tends to happen to implied volatility? Implied volatility typically tends to go up. So you could make the argument. You could make the argument that if a put diagonal, a long put diagonal spread, does what you expect it to do, meaning the price of the stock goes down, because remember, this is a directionally biased trade. If that trade does what you expect it to do, you perhaps have, as a trader, a bit of an advantage from that Vegas sensitivity. So in structuring the trade, one thing to pay attention to is this number. How sensitive is the trade to volatility increases? And so if we were to come down here once again to our controls in our risk profile graph, and we open that up and we say, all right, what happens if implied volatility goes up? Because remember, when implied volatility is low, it's likely to go higher. What if implied volatility goes up 10%? what does that do to our profit and loss? And that increases our profit and loss. You can see what it does to the risk profile graph. It raises that point at which their maximum theoretical gain finds itself, and we take advantage of that increase in implied volatility. Now, we can adjust this all we want. We can adjust the short leg. If we wanted to bring that short leg back in a little bit here, I'm going to make that volatility. I'm going to reset that volatility once again. We'll just make that 0, not up or down. We'll just bring that right back where it was. But we'll adjust this. If I were to push that short leg in a little bit closer to the at-the-money position, in this particular case, you can see what that does. That changes the delta sensitivity, makes it a little bit more delta sensitive. If I were to push it down a little bit, I were to push it down to, say, for instance, we said maybe down to the 230 level, a little bit more aggressive. Now we've kind of shifted this a little bit. We kind of have to go back and see what that does. And we're now at this particular point becoming very directionally sensitive. We kind of lock in that range up here. But if we look at the trade, that trade ends up costing us a bit. So it's got to make that move pretty fast because we're not bringing in very much premium. Now, if we go to closer to the at-the-money strike, let's go to, say, for instance, the 300 strike. Now you see what that scenario becomes. We reduce our directional sensitivity and we put it into a situation where we got to get lucky. So how you structure this trade, where you put the strike prices, where you put the expiration dates, determines the profile that you see in terms of that risk graph and what that trade is designed to do, and what that trade is designed to accomplish for your trading. So looking at these particular strategies, we've looked at two contrasting strategies. Now, I want to go back really quickly to that United Airlines strategy for just a second, and I wanted to tease you a little bit with this. I want to pop back over to UAL. Okay. Now what we've got is that United Airlines trade. We're going to go back to our Analyze tab for United Airlines. So there's that United Airlines trade. What I also want to do, I'm going to take that vertical out of here. So what if we looked at this chart and we said, look, United Airlines kind of, if we zoom in here, kind of looks a little bit like what we were looking at with some of those other trades where the stock was going sideways. So what do you think we could do with this diagonal spread? Do you suppose we could also create, even though we've already got in place that long call diagonal, could we come over here to the trade tab and could we create a roughly equivalent long put diagonal? So let's do the same thing. Let's go out to the 20th of March and let's go a little bit in the money here. Let's go to the 95 strike put option, and we're going to buy the 95 strike put option. And then we're going to close that expiration down. We're going to come to the 15 August, and we're going to expect that the price of the stock is going to maybe make that move to about the 23 delta. That's going to be the 8, we'll call it the 85 strike. 26, 23 delta, that's okay. We're going to go to the 85 strike, and I'm going to sell that 85 strike. And now what I've got is I've got a long put diagonal. So we already had a long call diagonal on. Now we're putting on potentially a long put diagonal spread, and my short strike here is 85. I know that my short strike over here is 97. So what I'm already anticipating is that I've got a range in which I expect the price of the stock to stay. So if I right click and I send this to the Analyze tab, look at what I've now created. Now it's a little bit offset because my numbers are a little bit different. I've kind of skewed this a little bit, but you know what I've done? I've given myself an opportunity in this strategy to see the stock stay within this range. And doesn't that remind us somewhat of that iron condor strategy that we put together the other day? Now, an iron condor benefits from the passage of time, but it works best when implied volatility is high. But what if implied volatility isn't high, like it isn't right now? then perhaps a double diagonal gives us a little bit of duration, gives us some opportunity to roll, creates the same kind of directional expectation, but benefits on both sides if implied volatility goes up. So what we've created in this particular case is what we refer to as a double diagonal, not the double super secret diagonal, but the double diagonal. We don't want to breach our etiquette by going straight to the double super secret diagonal. We're going to go right to the double diagonal. That's a little Christmas story reference there for you. All right, so what we've done is we've created a range in which we expect the price of the stock to go. I wanted to do that simply here at the end to illustrate to you the flexibility of these strategies that we've talked about. Remember, all we can do, the only thing that we can do with an option, or really the only four things we can do with an option: buy a call, sell a call, buy a put, sell a put. Those are the four things that we can do. Everything else is a combination of those. Now, I wanted to just touch on a couple of quick points before we go. After I tease you with that, I wanted to make sure we got that in. But remember, money management is important. Make sure that you keep in mind the amount of risk in the trade. Now, we were position sizing. We've been talking about this all the way along. Position sizing for that maximum theoretical loss in the trade. Now, exit considerations. Consider rolling if your expectation is still directionally consistent. But close the trade down if that changes. And if it starts to go against you, close the trade down. Sell back the diagonal spread. We want to be in the moving business, not in the storage business. There's some common pitfalls. The underlying stock price could move in the wrong direction, and you could lose that entire amount that you invested in the trade. So be aware of that. Look at taking that trade off if it starts to go against you. Define your line in the sand at which point you're going to cut the trade loose and move it or close it instead of storing it. Now, not rolling the trade if it's near that short strike. Don't try to avoid that assignment, but continue to roll that trade when it makes sense. And if implied volatility starts to fall, now it's pretty low right now. Falling beyond that is probably unlikely, but not outside the realm of possibility. But failing to account for falling implied volatility in that long option could reduce the value of that long option and could lead to a potential loss in the trade. So those are some of the common pitfalls. I just want to say this, Ray, and to Brett as well for helping out in this discussion. And most importantly, to all of you, thank you so much for being here with us tonight and with us all week in this virtual workshop. I appreciate you being here. Ray, I think maybe we ought to take this opportunity to perhaps show them where, because I know they've got a time limit here in terms of putting those questions in, where they can place those. Oops, you know what? Okay, here we go. Let's go to the homepage for this. And I got logged out of it because of the time. Let's go to the agenda for today. But what they're going to find is right down here at the bottom, there's going to be a page that will allow them. Let me see if I can get the real one up here. Ray, you talk about this for just a second. Let me see if I can get my reminder and my event hub, personalized event hub, back up here really quickly.
So in the chat, I just put the link again to go in to get to that page. You want to go down to the Q&A session to get to the event hub. Go down to the Q&A session, and you can see it divides it up into. You'll see the 4 sessions.
Yeah.
All right. And you put your question in there. It is right there. Submit your question or submit questions right there. The little orange button. There you go. You got the 4 sections. You can put a question in there. Again, I'm gonna have to close it off so I can put them all together, collate the questions, and get ready for the morning, so that we can rip through them pretty quickly and get as many in as we can. We only have an hour tomorrow.
Yep.
And so we want to make sure we can get as many as we can. So be concise with your question. Try not to drag it on, because I'll try to post the question in the chat at the same time. And that way you know what we're talking about. And we'll be good. Now, I will tell you this, folks. There'll be a lot of questions that are similar. So you may not see your question exactly, but I will do the best I can to try to capture the content of what everybody's asking. If there's several questions the same way, I may reword it a bit, but we'll get it in there for you so that you can have a really enjoyable and knowledgeable hour with us tomorrow morning. So
How
do
do
that
I
for us.
roll a diagonal spread? I'm just going to put that question in, Ray, so you can know that that's mine. I'm going to submit that. There you go.
And we'll probably use that because that's probably one of the questions you'll get.
Yeah.
It's a good question. All right. And so, and then the other thing on that is please do the survey. Matter of fact,
Absolutely.
the survey is linked to the top of the chat. You can see it up there right now. So please hit that survey for us as well. And tomorrow we'll have a survey at the end. I think it's just one question. It's pretty quick and easy. But get those questions in, and I'll drop the link one more time in the chat to get to the event hub. And the survey is tied to the top of the chat box.
And here's where, so I noticed, and a couple of people are asking the question, where can we find the recordings for this? Go back to your event hub from that reminder email or from the link that Ray is sending you. Go to resources, and then you're going to see those replays right here. And as soon as this one is posted, you'll see it populate right here under session 4. And there's the reference guide as well. So a lot of great stuff here as well.
So just want to be a big shout out to the Brett Crowler. Awesome job on the chat.
You guys kept him busy.
And he was flying, I'm telling you. And then so great job on that. And let me drop the survey. So I got a question on where's the survey. It's pinned at the top of the chats, but I will drop the survey link in one more time in the chat itself. There you go, folks. There it is. There's the survey chat. So hit that for us. And Ben, I'll get those to you just as quick as I can. And
perfect.
We'll see you in the morning.
All right. Hey, we'll see you guys tomorrow morning. It's going to be fast and, well, I don't know if I can use that because it's a movie title. It's going to be fast and heavy. Not heavy. It's going to be fast and fun. I'm going to call it that. Fast and fun tomorrow.
There you go.
All right.
All right. See you tomorrow.
Have a great evening, everybody. We'll see you tomorrow morning. Take care. Bye-bye.